I'm the Executive Director of FinTech at Cornell. I just give a word to FinTech at Cornell. We facilitate access, collaboration, and engagement among academics, FinTech industry practitioners, legal community, and former regulators across Cornell and across the external communities. We're honored to have with us today Professor Will Kong, who's the Faculty Director of the FinTech Initiative, and two practitioners, Lee Schneider, who's the General Counsel of Ava Labs, and Pat Dougherty, Head of the Digital Assets Practice at Foley and Lardner in Chicago. Pat also teaches a seminar in crypto assets and Web3 in residence at Cornell Law School. You are all giants in your respective fields, and we encourage a full and frank discussion. I am specifically not expecting full agreement here. I will ask each of you to give a 2-minute introduction and then we'll jump in. Let me give you a word about organization. We've divided this hour into 3 areas of discussion, starting with crypto assets, following with regulation, and ending with use cases, including decentralized finance, known as DeFi. I'm going to also give you a disclaimer, since I am a lawyer and a consultant, and there's a couple other lawyers on this program. This is not legal advice, and it is not investment advice. There'll be a place for you to ask questions. You can input them and type them. This event is being recorded, and we will, throughout the discussion, look at the questions, but save them for the end of the webinar. So let's go in order now and jump in. Lee, Will, and Pat. Can you each give yourselves 2 minutes, 2-sentence introduction, and then we'll jump into the actual content. So let's start with Lee.
Hi, everybody. As Susan said, my name is Lee Schneider. I'm a financial services and technology lawyer, currently the general counsel at Ava Labs, and always trying to be a general nuisance around blockchain and crypto.
Thanks, Lee. Pat?
Hello. I'm a Cornell lawyer, actually. I spent about 40 years in TradFi doing IPOs and such, and the last 6 years I've gone deeper and deeper down the rabbit hole of crypto assets and DeFi. My clients are exchanges, funds, development teams on 4 or 5 continents. I live in Chicago when I'm not at Cornell, and I'm coming to you today from Del Mar, California. Happy to be here.
Thanks, Pat. And Will, can you give us the final intro?
Absolutely. It's a great honor to be here today to join Lee, Pat, Susan. I'm a finance and management professor here at Johnson, and I'm also working together with Susan on our FinTech initiative. I've served on a few academic journals on the editorial board, and I'm also a research associate at NBER. Over the past decade, my research has been focusing on interdisciplinary issues related to tokenomics, crypto asset pricing, developing AI models for finance, and how digitization of big data interact with competition or growth and entrepreneurship. So I look forward to discussing all these fascinating topics with you all.
Thanks, Will. So I just want to also step in for a minute. So there are a lot of terms, and there's a lot alphabet spaghetti in this area. So when you use a term, I'm going to ask you to make sure that you define it. So Pat, I know that you said TradeFi. So that's traditional finance. DeFi, decentralized finance. When you use an acronym or a term, please define it. Otherwise, I'll call you out on it. So
fair comment.
Fair warning, right? Okay.
Yes.
So let's jump into crypto assets. Lee, can you give us a level set sort of 5-minute overview about what actually are we talking about?
Sure. And this is an area where I think there's a lot of confusion and a lot of misunderstanding. It is often the case that people say that crypto assets are securities, or that people say that crypto assets are all a type of financial instrument. They're not. Crypto assets can be anything. And why do I say that? Well, let's look at what blockchain technology does. Blockchain technology solves a huge computer science problem, which is how do you get disparate computers that are not operated by the same operator to agree on a common data set? And then from that, how do you establish digital uniqueness? That is to say, how do you give a digital item a unique identity in the same way that we know that physical things in the physical world are unique, like my iPhone is a unique physical item. How do you establish that digital uniqueness? And the answer that blockchain gives is you establish that digital uniqueness by creating a token or a crypto asset. Some people like to refer to them as digital assets. I actually think of digital assets as a broader category that would include assets that are maintained on a centralized database as opposed to a decentralized database across many, many computers. And so when I think about crypto assets, when I think about tokens and tokenization, I say to myself, well, anything that human beings can identify can be digitally represented with a blockchain token. And so they are not all securities. For example, NBA Top Shots are just like the baseball cards I used to collect when I was a kid. For those of you who don't know, NBA Top Shots are a type of non-fungible token that is sold by the NBA, and it's a non-fungible token representing a video clip of some amazing play by some amazing NBA player. I don't think any of us would say that those are securities or even a type of financial instrument. Another extreme there is Bitcoin. Bitcoin is the first blockchain. Bitcoin is the first token. It was designed to be electronic cash. It's designed to be a type of financial instrument, albeit one that's not typically regulated by the SEC or by the CFTC in its regular form. And so we can see just from those two examples that there are a wide range of things that can be created as tokens or tokenized. People are talking about tokenizing identity. People are talking about tokenizing deeds to property, tokenizing licenses, tokenizing all different kinds of things, because really what we're dealing with is database technology. Is that a good summary, Susan?
I think that's a really good summary. I'm just going to ask you to define SEC and CFTC just in case.
Okay. SEC is the Securities and Exchange Commission. CFTC is the Commodity Futures Trading Commission. The SEC, as the name suggests with securities, has jurisdiction over securities from a federal standpoint in the United States. And the CFTC, the Commodity Futures Trading Commission, has jurisdiction over all futures and derivatives related to all different types of commodities, as well as some very, very limited jurisdiction for spot market trading in commodities. And historically, there's been a number of situations where the SEC has claimed that something is a security, the CFTC has claimed that something is a commodity or a commodity future or derivative, and the two agencies have to sort of fight it out in a rumble to see who wins. No, typically they take it to court. They don't actually have a rumble on K Street in Washington, D.C.
Thanks, Lee. So now, Will, can you follow up on the concept of decentralization and what we're talking about, perhaps from the economic standpoint?
Sure. Let me first just say that I really like Lee's overview of categorization of crypto assets, because I'm absolutely agreeing with him. Not all crypto assets are the same, and it's a big gross mistake to treat them as together cryptocurrencies. And in fact, Lee and I have been doing some work to introduce finer categorizations. We could look into technical aspects. We could look into the legal aspects. And my favorite is actually the economic functionality of these tokens. Right? We talk about Bitcoin. That's kind of aimed at competing with fiat or with some form of money for general payment purposes. Whereas a non-fungible token is something completely different. It's not so much about the payment function. It's about ownership to digital art forms or even to physical assets, right? If we figure out a way to integrate various things. And in some of my earlier studies on categories and functions of crypto tokens and the empirical factor pricing of crypto assets, we do some careful work there, actually jointly with our Dean, Professor Andrew Crowley. Now, coming back to the decentralization issue, I think, I would say many practitioners and enthusiasts about blockchain would say, well, the decentralization does help with the avoidance of a single point of failure. That means if you store everything in the same node or same location, it might be destroyed and damaged, right? I want to emphasize there is a economic aspect as well. We are avoiding, with a more distributed network, some economic single point of failure. What do I mean by that? Well, we have a number of lawyers here, so I don't pretend to be the expert there, but I think it's easier to bribe a single judge than to bribe a panel of judges, right? So it's some degree of decentralization is helpful. It's not free. Storage and duplication, they are all costly. So, it's about the trade-offs. And I do want to remind everyone that decentralization also comes in different flavors. And if we think about what we saw in the case of FTX, the centralized exchange that has taken center stage of our attention for the past few months, it's not only about is decentralized so that there's enough competition. I'm viewing that as horizontal competition, right? We have horizontal competition in Web2 already. Service providers are competing, booksellers are competing. I think blockchain and Web3 is supposed to bring us more, both horizontal decentralization and vertical decentralization. So in the horizontal sense, we're trying to make intermediation more decentralized. We're trying to encourage competition and entry of service providers so that the intermediary rent or market power is going to be reduced. And that's a big antitrust regulation issue in Web2 world originally. But at the same time, what happened with FTX, for example, is really about vertical integration. So number one, it's already a centralized exchange. And number two is playing the role of not only an exchange, but also a brokerage house, custodian, a bank. That's problematic. And those are things that, when we were first discussing blockchain disruption and also crypto exchange was trading back in 2017, 2019, we actually did highlight this big issue, vertical integration, and we're seeing that being played out, unfortunately. So we have to take actions to first understand all these issues and to remedy the situation.
Thanks, Will. So before we jump over to Pat, my question is, perhaps compare a decentralized exchange to a centralized exchange. What does that practically mean for the participant? I mean, why is everybody so excited over the concept of decentralization? Because putting it maybe in some practical term might go further to understanding what all of the conversation is about. So can you compare maybe what a participant does in a centralized exchange? We know that's like a stock market. It's like anything that we have today. But what's different about a decentralized exchange? From the participant's point of view. Actually, whoever wants to jump in for this one, again, I don't mean to pinpoint you, but who would like to jump in and say
Well-
what's different for the participant? Why is this so exciting for them?
Well, briefly, for a centralized exchange, there is a central actor. Those who buy and sell on that exchange are transferring assets to that central actor, the exchange itself. So they're relying upon that central actor to perform a function. In a decentralized exchange, no, it all runs according to smart contracts. There is no central actor. And therefore, there is no opportunity for human error or human mischief or human thievery, frankly. And accordingly, the decentralized exchanges that exist have shown none of the problems and none of the shortcomings, none of the fraud that you've seen in FTX.
So
and just to add,
go ahead. Sorry, Lee.
Sorry, Susan. Just to add to what Pat's saying, and he's absolutely right. Susan, you and I and Will and a bunch of other folks collaborated on a Cornell Convenes conference and did some interesting work related to the question of when DeFi versus centralized finance or CeFi lending platforms and how they fared comparatively as a result of some big market events in crypto. And people can take a look at the paper that we included on that topic in there. I will just add one other quick thing to what Pat said, which is everything that Pat said is 100% right, but it's all in the background for human beings. So when a human being is interacting with the code of a DeFi exchange or interacting with the code of a CeFi exchange, the user experience, if you will, should be more or less the same, right? It's really about how orders are getting matched and how trades are getting executed. Now, the really interesting piece here also to me is, again, in a centralized exchange like the New York Stock Exchange, you're talking about stock trading. In DeFi, you're talking about trading any tokens. And so going back to what Will was saying earlier, and what I was saying at the beginning, you can end up with these marketplaces where all different asset types are trading against each other in ways that are very unfamiliar to people who understand TradFi, traditional financial services, that Patrick mentioned in his introduction, where stocks trade over here and bonds trade sort of differently in a bunch of different ways, and futures trade on these specific markets. And if you want to trade options, you got to go way, way over there to trade options, et cetera, et cetera. So with DeFi, because everything is on blockchain, because everything is on the internet and accessible by anyone from anywhere, and you can tokenize anything, you end up with a situation where all manner of things are trading together in one marketplace, one big marketplace.
That's a very, very powerful concept too.
So I think, you've unleashed a liquidity genie across whatever assets can be tokenized, is how I like to think of it. But also, Lee, you brought up a really interesting point where anybody can trade it. So the barriers to entry are quite different as to who can trade. And I think that's a really important point, because there are not in traditional finance, there are definitely barriers to entry as to who can participate. And in this, there are less barriers to entry. That can be a good and a bad thing, because you would need sufficient education along with that, which I would argue doesn't exist, but in a really robust form. But it's a different animal because of the way that it enables people to embrace different types of assets. So now that I've been off my soapbox.
No, and maybe we should just explore this tangent for just another minute, Susan. When we think about traditional financial services, again, we think about financial instruments. And it's easy to fall into the trap to say that DeFi is just like traditional financial services, except it's decentralized on blockchains. But again, the range of asset types, you can actually think of it as being more like eBay in a sense than it is like stock exchange, bond market, and that kind of stuff.
Yes, because anything can be tokenized.
Right.
And-
So this actually, sorry,
if I may
Will.
just add a
Yep.
nuanced point on what Susan and Lee, you mentioned earlier about the user experience. Even though the type of interaction to the users may not be very different from a centralized exchange and all that, because the backend is so different, the type of risk might be very different. For example, you face from running in a way that's different or potentially different from traditional asset markets, right? There's the discussion on maximal value extractable value, right? Where whoever is mining or recording the transactions in the system might take advantage of the fact that your order is transparent in that ecosystem. That's not quite the case in traditional settings.
So I agree. This topic could probably be its own seminar,
right?
But we have to move on to the next section, in which actually we have a question from Mike. Without some central control, how can you assure that the transaction is legitimate? At the end of the day, I feel there has to be some regulating body. And this feeds really nicely into our next section, which is regulation. So Pat, can you kick us off on regulation?
Yes, and I'll try to answer the question first. The legitimacy of the transaction is confirmed by network participants themselves. That's the beauty of a decentralized network. The miners, if it's proof of work, or the validator nodes, if the network is a proof of stake network, will by consensus, probably majority rule, but it might be otherwise, they will agree among themselves that the transactions are legitimate, and that is the confirmation, and that is what avoids the need for a trusted intermediary. We'll talk more about that in a minute. Briefly, regulation. Well, Lee alluded to two regulators, SEC, CFTC. There are others. There's also the Treasury Department. Specifically, there is the Treasury FinCEN, it is called, which regulates money transfers and whose goal is to prevent the funding of terrorism and other public evils. And there's also the IRS. We're not going to get into that today, but the IRS treats crypto assets as property, and it taxes them, transfers in them as it would as it would tax other transfers of property. So we have the SEC, which views crypto assets generally, but not always, as securities. We have the CFTC, which views them often as commodities or derivatives or swaps. We have the Treasury FinCEN, which views them as currency. And we have Treasury. Lee pointed out that sometimes there are contradictions here. I'll point to an obvious one. Treasury FinCEN says that crypto assets are currency. Why does it say that? Well, it has some of the features of currency, some do. And oh, by the way, if it's currency, Treasury FinCEN has the right to regulate it, right? The SEC says, well, wait a minute. Crypto assets are not currency. They're securities. Why does the SEC say they're not currency? Well, you have to ask them because they haven't explained that very well. But it's the truth that if crypto assets are currency, then under the securities laws, the SEC does not have the right to regulate them. It does have the right to regulate securities. It is a Securities and Exchange Commission, not an investment exchange commission. So its jurisdiction is limited to securities, not all investments. That's a very brief overview of the regulatory system. Other nations have it simpler. They might have one regulator or two rather than 4, 5, or 6 as we do in the US. Makes it more challenging for United States business men and women to bring new products along, trying to figure out which rules apply and how to make it work.
Thanks, Pat. Can you add a sentence or two about the state regulation? Because most of these cryptocurrency markets operate under the state money transmitter laws. 50 of them.
Electrons go everywhere immediately, right? So, and there is no preemption of state law under existing money transmitter law. There are bills in Congress that would change that. But under existing law, if you are a money transmitter, then you have to be registered in every state in which you do business. So that's 50 states plus a few territories, plus the feds. And by the way, there's a Cornell connection to the money transmission industry. The preeminent money transmitter is Western Union. Western Union was founded by Ezra Cornell. So we have the great irony today that the Western Union is potentially being disrupted by decentralized protocols, making it cheaper, faster, easier to remit an asset from the US, for example, to Mexico or to Sub-Saharan Africa or to India, which is commonly done.
That's great. Great summary. Lee, do you want to comment?
The only thing I'll add is, as Patrick pointed out, electrons go everywhere automatically. And although we in the U.S. spend a lot of time thinking about our regulators here in the U.S., as Patrick pointed out, that's only one sliver of the world. And there are many other regulators globally who have focused a lot of attention on crypto assets. The Europeans, having one consolidated market, their market in crypto assets regulation and some related things will be coming out and going into force probably in the first quarter of next year. Japan was the first country to have comprehensive crypto asset regulation as early as the spring of 2016. Singapore has been regulating it. So we see lots of different flavors of regulation around the world. Interestingly, most of those flavors of regulation don't do such a great job of distinguishing between Bitcoin and Top Shots, to use the examples that I used earlier. So we spend a lot of time, people like Will and Pat and myself, spend a lot of time talking to policymakers to make sure that they get where things are.
Thanks, Lee. Will, let's have the non-lawyer perspective about what you think about regulation.
Sure. That's actually a topic that I care deeply about. I think the truth is there are more regulatory problems or challenges than we have time to cover in today's panel. But I'll highlight a few, and I think they are all related to what Pat and Lee mentioned earlier, right? Pat was pointing out that tokens are, in truth, hybrid assets. It shows or exhibit properties that resemble different asset classes, and that's something you can actually formulate very rigorously in mathematical terms. In a few tokenomics papers, we actually write down a dynamic valuation model to think about it, and we do see it has similarities to commodities, to securities, and to currencies. So I definitely agree with that. What that implies is that without a clear regulation or coordination, without clear disclosure requirements, we are going to face this transition period where all these issues could show up. We mentioned vertical integration, centralization. That's just one of them. I think Pat touches on the taxation of crypto. That's another place where we need some sort of policy coordination. The fact that IRS is tightening crypto tax scrutiny is not sufficient, because if you are not banning wash sales, right, which is essentially buying and selling immediately of the same assets, or buying and selling within yourself, so that you can create the image or impression of a bigger volume and all that. If we don't ban such wash sales, taxpayers are just going to develop tax loss harvesting strategies. So there are loopholes that market participants can exploit if policies are not fully coordinated. And that's just the market side in terms of manipulation. If we talk about the cybercrime, that's another big Pandora's box. And I think up to now, the biggest ones that we experience are essentially crypto-related scams. Plus token is a good example, involving billions of dollars that's lost, and over 3 million victims. And there are ransomware attacks where you use malicious software to lock up people's data, and which is only unlocked when ransom is paid. In fact, our Digital Economy and Financial Technology Lab is launching this project. We're still thinking of a good name. I'm just going to refer to it tentatively as a project DarkSide. We're just looking into all types of ransomware attacks, darknets, money laundering with crypto assets, scams, basically an anatomy of crypto-enabled crimes. And our goal is not to just point out there's a dark side. Our goal is really to explore how blockchain analytics or blockchain forensics could come to the rescue. And we also want to tie it to what we already know in our legal studies, in our economic studies. In other asset markets, we know there are market manipulation, right? Pump and dump, insider trading. We should learn from the lessons there to better regulate the market here. And in addition, we have these tools. We have the data available, at least for permissionless or public blockchains. So we can pull those data to help with regulation and with compliance as well.
Thank you, Will. Again, another subject for a much longer webinar. But let's turn, we've had a lot of questions on DeFi, so I wanted to start to address that and other use cases. So we've heard a lot about DeFi. So I know, Will, you probably have some opinions about this and applications beyond it. So do you want to kick us off on just sort of a little bit of,
Sure.
So we've had some questions from people who say, not really sure what DeFi is. Can you explain what that is? And, how actually is somebody compensated for all of these digital transactions if it is peer-to-peer? So if you can start us off on sort of some definitions or some overview of DeFi, then everybody else can jump in. And I'm sure if we don't get to all of your questions, we'll have another webinar.
Yeah, and DeFi by definition is decentralized finance, and it's essentially providing, I view it as financial intermediation or financial services, utilizing distributed ledger technology. Blockchain is one of them, and smart contracting and digital tokens or digital currencies in the space. This is a topic actually when we invited Lee to speak in my class, he gave a great introduction there as well. So I'm actually hoping that Lee can also share a bit more in that space.
Lee?
No, thank you, Will. So the shorthand that I use to describe DeFi is that it is autonomously functioning code that takes existing market structure rule sets and puts them into code that anybody can use, anybody can access on a blockchain. So think about this is actually an interesting topic to think about for more than 2 seconds, right? Blockchains are these decentralized networks that operate based on a code base, and then somebody builds an application called a smart contract on top of that code base that also functions autonomously through the way that the blockchain is keeping track of all of the transactions. So you have 2 layers of autonomously functioning code that no human being controls, that no human being can stop or interfere with. Now, as an aside, there are some projects that call themselves DeFi, but they can interfere with the code, et cetera, et cetera. So when you think about DeFi, it's important to understand whether or not people have control over the code. But when people truly do not have control over the code, that is to say, it just functions because blockchains allow for it to function on the internet, what you've got is a situation where nobody's collecting a commission. There's no intermediary who is standing on one side or the other side or both sides of the trade, and making sure that buyers and sellers find each other. All of it is reduced to computer programming, and that computer programming functions directly on the blockchain. So that's the way that I think about DeFi. And the last point I'll make, and I know I'm going to sound like a broken record throughout the rest of the webinar as well, but remember, it's called DeFi and there's the finance thing, but it's just markets with assets, right? So you can trade any type of token. Anything can be tokenized, so you can trade anything that is tokenized. You can borrow anything that is tokenized. You can lend anything that is tokenized. You can post as collateral anything that is tokenized. So although we call it DeFi because many of the basic structures look like markets that have traditionally functioned in financial services, it can be any asset type.
Thanks, Lee. Pat, do you have anything to add before we take some questions?
That's a tour de force. I'm going to just go on to your next. No, truly, go on to your next question. I might have something to contribute, but I can't add to that.
Okay, so we have some.
I think that's the first time I've left you speechless, Pat. So I'm going to give myself a kudos for that.
I'm taking notes myself here, Lee. This is great.
So,
I've taken notes earlier.
it's recorded. It's okay. So let's talk about some things that you mentioned, Lee. Disclosure, perhaps, how people will know what they're trading. If this giant eBay marketplace, are there rules for disclosure? And I think, Pat, you might mention something about the organization that's trying to promote those kinds of things. And because it is kind of a caveat emptor market at this point. And I don't know if you can say that there's full disclosure. I would sure that you probably could say that there isn't. So let's talk about, I'm going to give you a preview of questions so you'll just know what's coming up. We've had somebody who asks who's built the code and confirms that it works. That's a governance question and a technical question. We've got a question on whether or not you can become addicted to crypto. Is it similar to gambling? Interesting question. We've had a question on harmonization of regulation on self-hosted wallets. So But let's talk about first about, I think it goes to really fundamentally fairness when you have a market that anybody can enter. What kind of disclosure is needed? What kind of forensics exists? How do we understand and make this a better place for users to want to come play?
Can I take a shot at that one?
Absolutely. I was just setting it up for that.
Yeah, thanks. I'm sure my colleagues have views as well, but I'm going to address the elephant in the room that Will, talked about earlier, which is FTX and SAM and Celsius and Voyager and BlockFi. Unless you've been hiding under a rock, there have been several bankruptcies and disasters in what is commonly called the crypto industry this year. I'm going to say something important here. Those do not involve decentralized finance. They do not involve DeFi. They are not, in my view, crypto catastrophes at all. And now let me explain that. Every one of those companies that I just mentioned to you is a centralized business. They were run by live human beings. One was named Sam Bankman-Fried, for example, a live human being. I will add this, by the way. He's been indicted, but in America, he is entitled to a presumption of innocence. And as a lawyer, I want to remind everyone of that. He is entitled to his day in court. Do not rush to judgment against him. I'm not carrying water for him. He's not a client, but let's remember that out of fairness. Anyway, these were all centralized businesses. They had the same faults and opportunities for abuse that other centralized businesses have had from the beginning of time in every industry. In every industry. There is fraud, corruption, deceit in every industry that involves live human beings. And that, by the way, is why we need a Securities and Exchange Commission, a CFTC, and so forth, to police the live human beings who control centralized industries and centralized firms. On the subject of disclosure specifically, I'm going to give you a really painful case. It's the case of Celsius. Celsius was a business to which you could, as a civilian, transfer crypto assets or even US dollars. And Celsius would pay you a yield, a return, a pretty high one, maybe as high as 16% annually. The problem was you were literally signing over those assets to Celsius. There was disclosure as follows: a click wrap agreement that you had to click yes to. The click wrap agreement said, I've got the exact wording here in the court opinion, but I won't read it to you. It basically said, you're signing over title ownership of this asset to us, Celsius. We can do anything that we want with it. It's not yours anymore. And by the way, if we go into bankruptcy, those tokens that you've given us, they're owned by the estate. So the people running the bankruptcy, they can do with it what they want. You can't get them back. You're signing them over. That was in the agreement. It was a click wrap agreement. No one really read it, I think. But the judge said that that click wrap agreement was enforceable, and that therefore, when Celsius went into bankruptcy, all of its customers lost their tokens. This was such a horrible event, and this just happened a few months ago. People committed suicide over this. It was such a horrible event. Now, was there disclosure? Yes. Was it buried in the back somewhere? Absolutely it was. That really needs to change in a couple of ways. And so I'm involved in an organization, Lee has some connection to this too, called the Global Digital Asset and Cryptocurrency Association. That's a mouthful, but I think Susan's going to drop the website link into the chat here if you want to look. You want to look at this, the GDCA. We're coming up with some core principles that we hope that companies who are members of the association and others in the industry will adopt. And I say if they don't adopt it, then in many cases involving pooled assets offered to the public, the government should force them to adopt it. It's pooled assets offered to the public with centralized actors. The government's right to insist upon this. But we say as core principles, and these are just tentative, they're going to be refined, subject to comments you might make to the global DCA. We're going to say, you must segregate customer assets from the company's own assets. Keep them absolutely separate and make it clear that the company cannot use the customer's assets for its own purposes. That's directly in response to Celsius. And another principle is that you will provide very full and fair disclosure about how the protocol operates and what you can expect in dealing with the protocol, and what the value of how the token can be used, what are its consumptive uses. Some companies and some development teams do a very good job about this. Others, not so much. So there's certainly tremendous room for improvement, and there's probably room for some legislation in this area. And I'd be very grateful if the SEC would clarify its advice in this area, but I won't get into that right now. Those are my thoughts about it, Susan.
Thank you. Does anybody have anything to add?
If I may also just jump in, I don't disagree with what Pat was saying about the decentralization part, but Susan, you asked us to add some more diverse opinions, so I'm making an attempt there. I'm putting on my economist hat, right? Economics is about trade-offs, and I think there's the ideology-driven group that is asking for decentralization. Just like when people trade GameStop stocks, it was like waging a war against Wall Street institutional investors. But we are not decentralizing for the sake of decentralization. There are trade-offs. There are economic trade-offs, and I think eventually it's going to be a combination of centralized setup, of which regulation is one good example. Actually, we need regulation, but regulations often come from centralized entities, and decentralized structures. And in that sense, I think this is related to the harmonization of regulation as well. From the centralized side, right? For crypto investors or DeFi participants to go off ramp, right, through their banks, through other traditional financial intermediaries, regulators can definitely come in and regulate them, right? If it's a centralized exchange, even though we didn't do a good job in the past regulating centralized exchanges, going forward, I think that's something regulators can definitely work on. Now, the challenging part is there are entities or items that we actually don't want to be heavily regulated. For example, my own wallet, right? Individual traders, we want to protect our privacy. And that's related to the debate of central bank digital currencies, right? How much privacy should we respect and preserve when the governments or central banks are introducing their own digital currencies? So with those, and also with the true DeFi, right? Decentralized exchanges, decentralized protocols and apps, how do we regulate them? I think it's still a very challenging question. And that's where, to the extent that these are permissionless, which means open blockchain, or even permission blockchain, which is more like a cloud-based network, as long as we, there's some form of transparency on what is happening, even without the exact IDs, I think there's forensic work that can be done. There is analytics that can be done to figure out, how the system is functioning. Is the system inclusive? Is the system involving a lot of cyber criminals, right? Kind of money laundering their wealth and funds, things like that. So it's going to be a combination, and the latter probably requires kind of industry self-regulation or better designs of these protocols to make sure bad things don't happen. At least people don't all coordinate into the bad equilibrium outcome in the system.
Lee, I thank you. Well, Lee, I see you nodding your head, and I have a question to the group, which is that it's often been said, well, you can see what's happening on a blockchain, so isn't that transparent enough? my personal feeling is it is not. But I would like, Lee, do you want to step in and talk about what kinds of things might be needed to make that a little bit more enabled market that's a little more friendly to disclosure?
Sure. Look, I think there's a bunch of different things that we all need to start wrapping our heads around with blockchain technology that's different from the way we've been wrapping our heads around these issues from a regulatory and a legal standpoint in other contexts. You know, to your point, Susan, about the transparency of the blockchain, the ability to see everything that's happening on the blockchain, the fact that open source code is typically what we see with blockchains and smart contracts so that anybody can read the code. Now, that doesn't mean that I'm going to go read the code and configure anything out, even if I did try to read the code. But there are levels of transparency that are sort of baked into the way these systems are created and the way they operate that you haven't seen in more traditional technology settings or regardless of the industry. So that I think is a powerful piece of it. The other area that I see where there may be a shift in the way the law thinks about things is traditionally the law and regulation has said to technology creators and technology providers, look, you can put all the disclaimers you want. You can tell people that they have very limited recovery if everything goes to pot. And that's perfectly fine. That's totally cool. We are not going to impose further liability on you if you put all those disclaimers and limitations in your agreements. I don't know how long that lasts, right?
Yeah.
I think, you know, the reliance on technology is such that you know, courts, if the legislature doesn't do it, if the regulators don't do it, the courts are going to do it. Because taking a worst case example, right? I code a smart contract that's just going to steal all the tokens that get sent to it, right? And I go out and I tell everybody, hey, this is the next best thing in trading. It's the next best thing in lending. It combines both trading and lending. It's going to be so friggin' cool, et cetera, et cetera. But really, it just steals everybody's tokens who send the tokens to me. You know, I'm pretty sure that's still stealing, whether I've done it through code or I you know, some other way. And I can put all the disclaimers in the world about it, but a court is still going to say you stole, and a prosecutor is still going to go after you for the theft. Even if the prosecutor doesn't, individuals will be able to sue you in a civil context to recover what you've stolen from them. And so we're going to have to start parsing, like, at what point was the coding such that, hey, it was just going to steal your money, versus, hey, there was an innocent mistake in the coding here that the coders didn't pick up on that allowed somebody to exploit it. And so we don't hold the coders responsible. We hold responsible the people who exploited, who used that exploit, right? And how do we think about holding those hackers responsible? These are questions that the law has not had good answers to. And I'm not just talking about in the US. In many jurisdictions, there are not good answers to these questions. And I think, you know, those chickens are coming home to roost someday.
And so early on, I agree with you. Early on in this industry, you used to see when there were code exploits, people would post to Twitter, I got pulled, I lost my tokens, etc. And other people would come back and contribute tokens back to them to make them whole. So in a sense, the coders themselves were when it was a really young industry, starting to make each other whole in the effort to say the exploits weren't really malicious, they were just code that we didn't actually understand could be exploited. I don't see that going on so much today. As the industry has matured, the exploits are more intentional, I think. But you're right, there's no mechanism that we've seen. So Pat, do you have any thoughts about this?
Yes, Lee's addressing some profound points here. An expression you sometimes hear in this business is that law is code, or as it's sometimes put, I view law as code. I think what Lee's pointing out is that code can define the legal rights between and among the individuals who use it largely, their relationship inter se among themselves as a matter of contract law, what I agree to, what you agree to. But it does not override laws that apply regardless of our agreement. And those include criminal laws. For example, I cannot agree with Lee, hypothetically, that I have a partner who's annoying, and so I'm going to pay Lee to ETH to kill my partner. That's actually not an enforceable agreement, even if we agree with it, and even if we transact it on a blockchain protocol, because there's a criminal law that says that's illegal. And your contract is not enforceable. Worse than that, if you do it, you're going to go to prison. So it's important to know, if you're a coder, that yes, you can agree about certain things with other coders and other participants in the protocol, but you cannot override criminal laws. That's my contribution. Lawyers need to understand tech better to work in this field, but techies need to understand at least a little bit about the law to work in this field. It goes in both directions.
Thanks, Pat. So I think we're getting towards the end of this, and we've had questions on predictions of where you think this is going in the future. So I would say 3 years out and 10 years out. I'll give you a chance to think about that. Who would like to go first?
Well, I won't give you a time frame, but I'm going to just barge in there, and I'm going to mention network effects, which we haven't talked about yet. Network effects are destiny. Okay, Bank of America, for one, says, we're not quite sure what has value and what does not in the crypto sphere. It's hard to tell. There are thousands of tokens, not one or two, and we can't say it's going to be this one or that one. But we have global adoption of crypto assets that is continuing, and it's just spreading out, creating very powerful network effects. So I cannot tell you when we reach escape velocity. I don't know that, but I know this. The government really can't stop this. The government can slow it down, but the government cannot stop it. Global adoption of crypto assets is ongoing and inevitable. That's what I think.
Thanks, Pat. Lee, you want to jump in?
Sure. So, look, I think the biggest issue right now is how we get the user interface so that normal human beings, by the way, I include myself in this, right? Like every time I do something on chain, I am scared to death that I'm going to mess it up. And so it takes me an inordinate amount of time, and I double, triple, quadruple check everything. And even then, I have to take a strong shot of whiskey before I actually go through with the transaction. But we need to get that user interface to take away the fear of these transactions. And I think there are many teams working hard on this. But to me, the key to this gigantic network effect that's going to keep growing that Pat's mentioning, one of the keys is going to be that user interface, so that silly lawyers like me can feel comfortable using it.
Will?
Needs to.
Oh, go ahead, Pat.
Needs to be like getting in a car, pushing a button, and expecting the engine to burn, right? You don't have to know how internal combustion engines work. You just need to know you can push the button and the car will run. Same thing with crypto assets. We need to get there.
You with your internal combustion engines, Pat. Come on, man! It's electric motors all the way.
I'm in California, and I said that. I'm sorry. I'm showing my age. My apologies.
I share the insights from Lee and Pat. I'll try to answer that question very precisely. Like 3 years down the road, actually, I think the applications that is beyond crypto assets and DeFi might take place or take hold or take off first. That's basically using blockchains as a infrastructure, as a distributed database. There's already very much ongoing work in computer science and data science on secure multi-party computation, privacy preserving multi-party computation. What we mean by that is data is still siloed, yet in aggregate we can do something without violating the privacy or seeing the underlying exact information, but we can still use that to come up with cures for certain illnesses, or I've done some work on federated blockchain structure for auditing financial reporting, right? How firms can cross out account payable, account receivable, and I think even in delegated investment industry, which is huge, if you can prove using some encryption technology that's built on blockchain that my trading strategy actually works, it's going to make fundraising easier, right? There are many candidates, zero knowledge proof, other commitment schemes. So that's, I think, quite feasible over short horizon. Now, in the longer, very long horizon, all the things that we've been chatting about, I think, not very long, 10 years, would require some time to work out. For example, if we really want interoperability across different blockchain systems, so even across different Web2 systems, how do we do that? If we want to bring information and value on-chain, off-chain, online, offline, is there a intermediation or intermediary that can help with that, that's not centralized? And this has something to do with how we aggregate information, how we attach our non-fungible token to my house. Probably that needs to involve local authority and law enforcement in order to kick out renters who are not paying their rent, renting my house. So all these might take a little bit longer, and we'll have to overcome scalability issues. Maybe layer 2 technology would be useful, and I think it's a very exciting field, despite all the things that are happening. It's a general purpose technology that requires a lot of iteration and exploration.
Thanks, Will. I'm just going to give one final comment in that you've all said it. It's a global technology. So the push forward on this technology, while we'd be excited to have it happen in the United States, may not come here as fast, but certainly will come somewhere else where there isn't as much barrier to it moving forward. And I think that in and of itself is pretty exciting. So I think we've come to the end, and I want to thank our panelists for participating and for giving their valuable time to this, and hope you come back for more FinTech at Cornell webinars.
Thank you, Susan.
Thank you
Thank
for
you
having
all.
us.
This was great.